You have almost about 100 people that have lost their home entirely, right? Can you tell us how many of your customers have been impacted?
Well, if I take how many people have been evacuated, we're in we're in thousands. If we're looking at how many people have actually lost their home entirely, meaning there was a home there and now there's not, we're a little over 100. I think 104 at last count. On top of that, we have a large number of clients that had to evacuate and their home has damage, but it's not completely damaged. There's smoke damage. There's damage from the fire department's work in the area. There's ash. There's smoke, all sorts of things. It's actually one of the more complicated claims to handle is a loss like that than a total loss. A total loss, pretty easy. You go out, you look, no house. When there's damage to a house, but it's smoke damage and the windows might have melted from the heat and you have chemical exposure, that's a little more complicated for the claims folks to deal with. So if you add all of that up, we're probably going to be close to 200 or 300 people that have some type of fire-related claim.
And how is the payment? Are they getting paid based on the value of the home or the replacement cost? You said $2 million, $3 million wires coming through. Where does that valuation come from? And is it enough for the people that are...
Well, the policies all dictate how much they're going to pay. And all insurance policies are based on rebuilding the property, not the market value. So you might have something, obviously, in the Palisades, for example, that's very expensive market-wise. It might be $8 million to buy it, but the house is small. It might only cost $2.5 million to rebuild it, right? So when they purchase an insurance policy, if they purchase coverage that's sufficient to rebuild the house, then they'll have sufficient coverage on their insurance policy to get reimbursed and to have the home rebuilt. What we might see, unfortunately, is over time, and it's human nature, people sometimes like to save money, squeeze a little here, cut off a little bit there, and they would lower coverage. Who thought that the Palisades was going to have a loss like this, where the city is basically decimated? So I think the people that are going to potentially not have enough money to rebuild will be primarily people either that didn't carry insurance, and we can talk about that, or people that have over time lowered their coverage to below what the replacement value might have been. And fortunately, any gap that's there, they do have other alternatives they can go to. They can go to FEMA for assistance. They can also go to the Small Business Administration, the SBA, which are offering low-interest loans to try and make up that gap as well.
And how much does FEMA help?
Depending on if it's a residential home, a commercial home, or a nonprofit, I believe they'll give up to $40,000 or $80,000 initially for residents. For businesses, I believe it's $2 million, and nonprofits it might be $3 million. I also suspect because these values are so high, this is not what we're used to seeing when it's crazy to say used to seeing when there's a wildfire, that they just keep happening. But this is not what's been seen in the past. So I suspect that SBA might actually be making some changes at some point because they simply don't have enough for $2 million to be enough to help someone that has a $7 million gap between the amount of insurance they purchased and what it's going to cost to rebuild. The real problem is now what it costs to rebuild a house today could be 4 times more than it was 2 weeks ago. Because when it's just your house, the cost will be what it will be. But when it's the entire area, the contractors are in more demand, the costs of labor go up, the costs of construction go sky high. But the policies don't change. The policies are whatever you purchased. So I think we're going to see gaps between what would normally have been expected to be the cost to rebuild and this increased cost based on the availability and the scarcity.
And what about the people that have mortgages? How does that work? Because they don't really own the home, and if the home is gone.
Right. Well, people that have a mortgage, what will happen is we know that, for just an update, when you purchase a home, assuming you don't just write a check for it, like, I suppose some people do, but most of us, we buy a home, we put some money down, and then we go to a bank and we say, I need more money. And as collateral, in case, so you know that you're going to get paid back, you have rights to this property. Well, the banks say, okay, that's fine, but we want to insure that collateral. We want to be sure that we keep that safe. So they will be sure that you have an insurance policy for fire coverage. So when people have a fire loss, the money that's going to come in may or may not, it depends on the company, write the check directly to you and the bank to be sure that it's going toward rebuilding the house. Sometimes it might go directly to the consumer. Interestingly enough, the concern is banks are saying, we're afraid that people are not going to rebuild, They're afraid it's going to be like it was after the Northridge earthquake, where so many people didn't have earthquake insurance. They were just walking away from their loans. They would say, I can't rebuild, and the bank was stuck, with an outstanding loan. What's happening now, people have insurance, but they might not want to wait.
Because they have to take it when they have a mortgage, right?
Exactly.
They have to have insurance.
But you can't mandate they have earthquake insurance. So back when the big earthquake happened, a lot of people didn't have coverage. Most people will have fire insurance, but they might not want to wait. We could be looking at literally 2, 5, 6, 7 years before all of these homes actually get rebuilt. And that's a long, long time. Some people might just decide that they don't want to do that. They just want to see what other options they have to be able to cash out, pay off their loan, and maybe move somewhere else.
So in most scenarios, people will get the money themselves and then they have to pay back the mortgage, right?
Correct. The obligation is on the people that take out the loan, right? So if you owe money to a bank and the insurance company pays you, you can be sure the bank's going to come to you and say, well, you have to keep paying your mortgage. People might decide to take the money, go do something entirely different, but just keep paying their monthly mortgage. That's a possibility. I don't know how long the banks might allow that, because don't forget their collateral is gone now. They have nothing to be able to protect themselves if the person just decides to stop paying. So it'll be interesting to see how that happens. But I was speaking with some people over actually at Wells Fargo not too long ago, and they were saying that their big concern right now is people that don't want to wait to rebuild, and they want to just move somewhere else, or they just don't want to take the time and the stress to be in that area anymore. What's going to happen with those costs to rebuild, and what's going to happen to the money from the insurance companies, and how does it get to them?
Possible for people to actually go buy something else with the cash they get from the insurance and then actually transfer the mortgage there?
It's a great question, and the answer is yes. What happens is if they have a replacement cost policy in California, they have 3 options. They can use the money to rebuild the home right where it is, mortgage stays put. They can purchase another home somewhere else, and the mortgage will go over to that property. Or they can build a house somewhere else, and the mortgage will go on that house as well. So the bank's going to follow the property, assuming that it's rebuilt. If somebody decides they don't want to buy something else, they don't want to rebuild, then it's possible they're going to get what's called an actual cash value settlement, which is going to be significantly less than the policy limits are, because the policy is designed to rebuild, right? The idea with insurance is to put you back to where you were, not just put money in the bank, right? So the policy has provisions to prevent people from just pocketing money and not rebuilding, and that might not be enough to pay off some of these mortgages.
In terms of insurance prices in California, where do you think they're headed? Because this is a major disaster, and somehow we have to pay for it, I guess.
Somebody has to pay for it, right? And what's happening over the years, we've seen costs of construction go up. Costs of repair for vehicles goes up as well for automobiles. We see these prices, they keep going up. A lot of it's been a factor of inflation. What doesn't cost more money now? You go to the sandwich shop, and I can't believe how much money it costs to just buy a sandwich, right? Everything is more expensive, and insurance policies are buying all of those things, right? When people are out of their home now because of the fires, they're paying these higher rates for food for people to be able to eat. They're paying the higher hotel rates. So all of these increased costs that we're seeing started out, at least in some part, because everything was costing more money because of inflation. However, in California, we're so heavily regulated that the industry has been squeezed and squeezed and squeezed, where people that are in areas that are less likely to burn are paying more than they should because they're subsidizing homes that are in the higher brush areas. And people have been okay with that because the rates have been relatively comfortable. But now, because we're seeing so many of these wildfires, we're seeing fires not to this extent, but every 2 to 3 years. These types of events are what are called 250-year events. They're supposed to be happening every 250 years. That's how the insurance companies price them in their models. Now that they're happening every few years, rates have started to go up, 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 up. What we're going to see, I believe, is areas that are a higher fire risk are going to start paying significantly more for their fire insurance, and the people that are in areas that are less likely to burn are going to have a lot more competition with insurance companies, because that's where they're going to want to write. Those are the sweet spots where they're less likely to have some type of a major catastrophe. And when you have lots of companies that want to write in one area, competition will lower those prices. So I think we're just going to see the leveling start to shift. So you're going to be paying a lot more if you're in a higher risk area and less in an area that's not.